In 2020, Nigeria entered into a recession due to the fall in oil prices as well as the negative impact on the economy by the coronavirus pandemic. While the economy is expected to exit recession in 2021, the resurgence of the pandemic poses a threat to global economic recovery. And as a result, the Nigerian economy risks deepening further if the pandemic persists beyond the first quarter. The pandemic aside, Nigeria's policy environment remains characterized by uncertainty due to the inconsistent and unpredictable nature of the policy and regulatory environment, which continues to hurt long-term investment planning and business projections. Joining us now to look at all these issues and to discuss Nigeria's economic outlook in 2021 is the coordinator of Nigeria's successive plans to Vision 2020, the 2021 to 2025 Medium-Term National Development Plan and Agenda 2050. Professor Ken Ife. Professor Ken Ife, you're welcome to the morning show.
Thank you. Thank you for inviting me.
All right, let's start with the fact that across the world, Nigeria is not left out. Lockdowns have been lifted. Vaccines, in fact, by the end of this month, Nigeria will be receiving its own portion of the vaccines, and then, of course, there's social distancing and all that. How is this affecting recovery or the economic outlook for Nigeria and the world in general, actually?
Well, the COVID did two things immediately at the outset. One was that it disrupted the entire supply chain, global supply chain. And if you consider that 80% of our manufacturing capacity is dependent on imported raw materials, it took a hit. Then secondly, the big countries that buy our crude have already locked down their economy, so we couldn't have demand on our products. So the prices collapsed because of demand, and then also the volume collapsed from 2.1 million barrels a day to 1.3. So the cumulative impact was 60% drop on our revenue. So those two were very strong headwinds. And of course, I would say that Nigeria was rather more prepared for this than it was in 2016. So very rapidly, fiscal and monetary measures kicked in, and that's why it didn't go as bad as has been predicted.
Thank you very much, Professor. I want to talk about another plan that we had come across during our research for this conversation. It was a recent report by an institution called Sigma Pensions, and they called their report Nigeria 2021 Outlook, a return to normalcy, but tough policy choices lie ahead. In that report, they predicted that Nigeria's economic recovery would resemble a V shape, meaning that it would be a quick and sustained recovery after what we've seen was a sharp, economic decline. Do you agree with that, or do you think it's far more complex than that?
It is far more complex, but it will still be a V shape. The reason being that so many policy measures have actually kicked in 2020. But they will manifest far more strongly in 2021. I will look at the fiscal and the monetary policies that have laid a solid foundation for rebound in 2021. If you look at the monetary policy first, the three traditional roles of CBN is to protect financial system stability, then price stability, and then intervention, statutory intervention in areas where there are market failures or to strengthen our industrial base. So they took action, and very, very early action, because if the CBN didn't do what it did by granting forbearance, statutory forbearance to the financial sector, to the banks, to restructure loans and brought down the interest from 9 to 5%, and then went straight away to attack the demand side of the economy, and while on the other hand, concentrate resource on the supply side, is a balanced action. So what he did was, first of all, he gave 50 billion to be disbursed, targeting micros and household, and then increased that to 150 billion. The reason is this: whilst you have the likes of their 3.5 trillion, 1 trillion to manufacturing sector, all chasing output, increased output, and increased resilience. But don't forget that when you look at the consumption side of the GDP, 85% of consumption is household consumption, and government is only 5.7%. So if you produce and produce and produce and nobody has the capacity to buy, then you are back to square one. You will now have what they call collapse in aggregate demand, which is the same way drags you back into recession. So they did that, and that's why you have Nigeria not going into the depth that has been predicted. But at the same time, too, there are other areas that they injected a lot of energy. Like, for example, you had convened, or the private sector convened, and agreed that they are going to build an infrastructure company and capitalize it with 15 trillion naira, not dollars, but naira, so that they can take off all that excess luggage of infrastructure from federal government and run with those and free the federal government to focus on all other areas like social inclusion and energy and gas. So they wanted to do that. And then there are other things that they did. Remember, the main thing about CBN was to move resources to the private sector. That was the plan of 2017, EIGP plan. It carried on. It never gave in to the risk-based supervision. They continued to rein on the banks to make sure that their non-performing loans are within limits of about 5%. Capital adequacy ratio was reasonable. So all of those kept on, they were very healthy. And then that means that the bank was even able to grow in the recession rather than suffer any hit. It grew. And they already had infrastructure like ICT embedded in the banking sector. So they used ICT extensively and they never saw the recession. Then also the ICT itself posted the highest growth of about 15% and now moved to the biggest segment of our economy at 14% of the GDP. So all of those were not by accident, they were by design. So whilst that was going on, then in terms of fiscal policy, you also had a more robust response from the fiscal policy authorities. The incentives came to ensure that, do you imagine that once we have returned to January to December cycle, budget cycle, there was also reforms coming along each budget, reforms coming along each budget. So each of the reforms preempted what was coming. So you had so much incentives, like removing the VAT on companies before $25 million and all of that. So many incentives that just came handy. So they didn't need to now go to incentives, but then focused on rehabilitation and massive intervention at the household level, and also tackling the weakest of the weak, and bringing in this robust program of economic sustainability plan. You always need a plan when you have a thing like this. This was what happened in 2017. Everybody said, where's your plan? Where's your plan? So there was a plan. And they're working through the marching orders on the plan.
All right.
So now, I would say that the foundation for recoveries have been laid on both fiscal and monetary policy side. And it is now going to get more traction. And that's why you might support the case for a V-shape. That's where you find the foundation.
All right. You've raised quite some issues, the case of infrastructure, and some other issues. We'll get to that. But let me take you back to, you talked about the oil, other parts of the world that buy our oil. Now, there's been production cuts by both the OPEC and the non-OPEC countries, and there's been improved demand, at least it has led to the upward movement in November to December 2020. Now, the question is, do you see this trend continuing? How can we build up on it, especially, Prof, with the second wave that we're experiencing now?
Now, see, the budget assumptions were, remember, we came from $57 per barrel down to about $20 per barrel. And now we are now bouncing back. And our new budget projection was based on $40 per barrel. In fact, that is consistent with the long-term projections by the likes of U.S. Energy Information Agency and all that. So, but the reality now is that we managed to go up to $52 per barrel. What that means is that we have a headroom. And that headroom allows accretion to excess crude account and accretion to reserves. That's why you're having some marginal increase in our reserves. But will this be sustained is a big question. Now, the second wave, yes, including the other variants of the disease. Yeah, the second wave, yes, but by March, April, that will subside because it's aggravated by the weather. by the cold weather. And then the vaccines are coming in handy. So I think we will see a drop in that. And then, but don't forget again that China has returned to full capacity despite the COVID experience. And so in terms of oil, I will still see that we will be anywhere between 45 to 50, for about 6 months or something in the period of the recovery. So we will be running ahead of our budget provision and then having some marginal increase in accretion to the reserves. It wouldn't be as much as we had wanted because there was a complete meltdown on the foreign portfolio investment, and for obvious reasons. And then also capital importation report, as you saw, 2017 was 2018 was $17 billion, 2019 was $25 billion. This year, last year, we'll be lucky if we close at $10 billion. In fact, the first quarter was $5.8 billion, second quarter $1.5 billion, third quarter $1.4 billion. Meltdown. It was the COVID that was the culprit. COVID brought down those capital importation. So we're not going to do away with that, but there are other creative liberalization going on in the forex arena, like the foreign investor window, exporter investor. So that is still ticking. So on balance, I would say that we will still be able to get by, but at very, very challenging times when it comes to the forex regime. Very, very challenging times. That's why you're seeing the devaluation and all that. But it's very, very challenging. But I think we'll still pull through. The reason being that the things I started by talking about, the foundations that have been laid to maintain a strong and stable financial system, and then also to attack the failures in our market economies, which is what the massive domestic finance intervention is addressing. And it's very serious. You need to understand the gravity of the interventions that we have in the domestic area, which is what not only that is restructuring the economy in a way that we haven't seen before, but bringing the subsistence farmers that are scattered all over the place, couldn't access finance. Now, over 4 million farmers can access finance, only based on their BVN, and then dealing with nearly 5 million hectares. And what you are doing there, you are transforming that sector from subsistence farmers to commercial farmers because they are integrated into the national and global supply chain with anchors. So there's an organization there. And I only pray that it extends to all the states and then it increases beyond 10 presidential value chains. But there are signs of change.
I know we're getting to, we've already touched on the devaluation of the Naira, but I wonder if we could speak a bit more about that. Specifically, if we're talking about financing Nigeria's current account deficit, the fact that we already have a weakened Naira because of what's happened throughout 2020, if you were to look ahead to the rest of this year, how are you expecting that side of Nigeria's economic recovery to materialize with so many other restrictions happening in terms of Nigeria's Naira, the Naira expecting to weaken further this year?
Well, the thing is, part of the story about the weakening of the Naira are to do with shortage of funds, and also we are exposed. Our economy is exposed to a monocultural economy. We need increased diversification of that revenue source. If 90% is coming from oil, then it's inevitable. You are going to be running through this crisis year on year. It's going to be continuous. But there's also another side of the story, which is about our debt.
Professor, my apologies. We have to interrupt you there. It is time for us to take a very short break. But once we come back from this break, we will continue on with this conversation. Please do stay with us. Welcome back to the morning show here on Arise News. We're still joined by Professor Ken Ife, who is here to talk to us about Nigeria's economic recovery. Professor, before we went on break there, before we were interrupted by the break, you were talking about Nigeria's current situation with the devaluation of the Naira. I had asked you, the fact that we've looked at our current policy settings around the exchange rate, it does seem as though there are limited options for Nigeria in terms of financing its current account deficit because of this weakened Naira. If you could continue on your points on that question.
Yeah, so I was saying that not only that you're looking at the supply of foreign exchange, which is primarily from the crude oil, but there are also other areas like the diaspora remittance, for example, that brings in about $26 billion, much higher than the oil in itself. And then you saw the action, the robust action that the CBN took. It said, look, stop exploiting the situation. Let's have this naira, but this dollar go straight to the domiciliary account of the diaspora, and then pay people their dollars, and then let them go to the market and change. Because what was happening, you know what was happening. Everybody knows what was happening. And then when they were not playing ball, the bank just ordered the commercial banks to close the accounts, the naira accounts of the IMTOs. So measures are taking place, and you could see the reason. The money dropped, the quarterly remittance dropped from $6 billion a quarter to $3.3 billion a quarter. We couldn't let that continue. And then, so it brings some order. And there are all the other actions that are being taken to ensure that it's not just the policy, but the foot on the ground are able to work together to implement the policy. So it strengthened that side of things. Then you also have the MPR rate that was coming down gradually to 11.5. I hope that this year there may be a little more drop in that. But look at the whole project to move resources to the capital, to the private sector, which is the big thing. You have to get more and more resources to the private sector. So CBN doesn't just continued. It didn't give up on stricter implementation of prudential guidelines and maintaining the health of the sector, but also continue to push the private sector, the banks, to bring more money to the private sector by increasing their loan-to-deposit ratio, to make them lend more, not just use this money and go and trade on the treasury bills and stuff like that. Then he got them to differentiate. He had differentiated cash reserve ratio. Come and take some of the money. I have over 4 trillion naira of your money with me in the central bank, any use zero interest. Come and take this money and lend to the private sector at maybe about 9% or 7 years. So that was also continuing, and they were improving, gone to 65%. So it increases. So it continued to put pressure on them. Let me tell you why it's necessary. Why the CBN could use domestic intervention to bring out all over 2 trillion now. If you look at what it's doing in all other areas, power sector, all that, but only a limited number of businesses can access this. We have 44 million MSMEs, maybe 1 million can attend. So in the end of the day, you got to get capital out to the banking sector so that the 43 million will go to the market and borrow money. So that is why he's pushing. And then let me tell you one more thing that has happened that is absolutely good news. I haven't seen people talking about it. CBN kicked out the private sector from their open market operations and then prioritized foreign investors coming in. Then the yield on treasury bill dropped dramatically from 14% all the way to 10%, less than 1%. Now, the impact of this was that there's a huge liquidity in the private sector. And who benefited? Guess who benefited? The capital market benefited. That's why they were voted as the best by Bloomberg. But also, the corporates are now coming to the market with their commercial papers, commercial bonds buying at 5 to 6%. In other words, they are now cheaper money. Money is now cheap. So that's why I'm very anxious for this infrastructure company to go out now and take their 15 trillion at a low interest rate. And then you can now see how the whole arithmetic will begin to add up in terms of the resilience of the economy to push for that growth that we expect in this first and second quarter. So the foundations have been laid, very, very robust foundation. Then if you look at the fiscal policy side, whilst we've done the budget running, we have two budgets running simultaneously in the first quarter. The about 1 trillion that has been underspent on the capital is going to continue for 2020, will continue in this first quarter. While at the same time, this 2021 budget, which is about 30% capital component, will also run concurrently. The effect is that there will now be more injection to the private sector, to the construction, to the capital side of and that is where the jobs lie. Yeah. And that's where the growth we are looking for is going to come from.
All right. You talked about MSMEs, quite interesting. 65% of our GDP is controlled by this sector. I heard you say that in a particular program. And much of the cash, too, is in this particular sector. 65% is quite a number. How can the government,
correct,
Nigeria,
including the informal sectors,
yeah, begin to really leverage on this sector for the kind of economy we need to have in 2021 and further?
Yeah, one is, the reason why we are even borrowing is because we didn't have national savings. If we had national savings, we wouldn't have had the cost to go for massive borrowing. But you could see now that the savings of 11 trillion on the pension fund is coming in handy and helping. But the government is looking at national savings bond, which is going to hit that informal sector segment and mop up a lot of the liquidity that you have there. Because there are more people outside the banking sector, and there are more money outside of the banking sector. And that's why you find sometimes that the monetary policies cannot do the magic that you expect it to, because a lot of the money is outside your orbit. Okay, so that is happening, and you're going to see more of it happening in this period. Now, the domestic finance intervention. Now, let's take one or two. If you look at the earlier power, see the shenanigans going on in power. Just look at that. Such a disgrace. And while you compare Nigeria and South Africa, you will know that we've got a long way to go. 4 times their population, but they have 10 times our power. So a factor is 40 times. So, and you've been hearing the same story, 4,000, 5,000. Or for how long? Now, what the CBN now says is, okay, I'm going to commit to building an extra 7.5 trillion power GDP by going to solar, off-grid, mini grids. That is taking power to the mass market. So on one hand, we have Siemens coming in with end-to-end intervention in power, all the way from production to distribution. So that is good news. We're down, but everybody is allowed to play in this sector by taking this power to the mass market. So what are now going to have? You're going to have a sea change in power. Why is this important? 30% of the unit cost is power. Then transportation is another issue. That 20% of the input cost is transportation, and it has even gone completely out of hand. You've seen what is going on in Lagos. To simply move one container from the seaport into Lagos, it used to be 200,000, now it's 1.8 million. You've seen the reason. Everybody now knows that it's very important to have the rail to connect. So important, so that you can open the economy. Even our production, where 30 to 70% of what we produce in agriculture still can't make it into the food chain because of post-harvest losses, transportation difficulty. The price difference between a ton of soya beans in Katsina and Kanu, and then compared to Lagos, and the price difference is double. At 100,000, by the time it gets down to Port Harcourt or Lagos, it doubles to 200,000. The reason is because transportation cost of that 1 ton is 75,000 naira. So we've got to deal with this. If you are using rail to move it, one rail will have 30 coaches, it will have 30 containers. It cannot be anywhere near. It will cost you 5,000 to even move that container. Transportation is so critical. And though they are going to complain that fuel price has gone up and all that stuff, but these two are binding constraints in our economy. So we'll have to deal with those. But having said that too, you also look at what else is the fiscal doing in this space. The narrative about Nigeria borrowing is this. Give them money and then base it on the cash flow. And then when you look at the cash flow, you have big challenge. The debt service to revenue ratio is about 42% now. It actually came down from 50 to 42%. But then we have to change that narrative by looking at where is our asset? What balance sheet do we have? How can we sweat our assets so that you can borrow money based on these assets? So you change the picture. Nobody knows about the value of Nigeria and Nigerian government asset, federal government asset. Nobody knows. The government is looking at that. And I know that announcements will come very soon because they are deeply trying to do something there so that the narrative around our lending and borrowing, because what they say now, why you want to give them how many more billions? They're likely to be insolvent. They're in fact technically insolvent. So, but the story will change. It will change. And also look at the budget. You've seen some MDAs have come in with 1.35 trillion on the revenue. So that story is changing only because the foundation have been laid in 2020 and they will yield fruit in 2021.
All right.
Going forward.
Indeed, well, it looks as though we've come to towards the end. I think we still have time for one last question.
Ooh.
If we were to, do we or don't we? If we were to very, very quickly talk about Agenda 2050, perhaps not. It does look as though we've come to the end of our time. Do we have enough time? We do? Fantastic. Professor IFE, I wanted to ask you about Agenda 2050. We spent the bulk of this conversation talking about the difficulties facing Nigeria's economic recovery because of the year 2020 was for everybody, not just Nigeria. But if we look ahead to Agenda 2050, is that still on track, or do you think that it's still, even though it is quite some time away, it will take a seasoned effort to get to the planned type of Nigeria we're expecting to see in that year? Briefly.
Well, we have two plans. First of all, there's, besides the crossover, because the Economic Sustainability Plan is a crossover from the EIGP that ended last year and then crossing over. The first plan is 2021 to 2025. We have submitted the plan and then it's all being tidied up. The second plan, which we are going to commence shortly, is to Agenda 2050, which is now extrapolating to 2050. What I can tell you is this. The foundation for the economy has actually been worked on. We are now bringing technology, digital economy, because what defined Nigeria in relation to the peer economies that are doing many times better than us, like Brazil and all that, the reason is because these economies have allowed technology to influence all factors of production and means of exchange. Now we are going back to that route. We are not going to base it on oil anymore. We are now bringing technology, digital economy, bioeconomy, science, technology, and innovation to the center stage of development planning. And that means that as you look at every sector, we are looking at innovation ecosystems in each sector. So we are seeing innovation and technology as a cross-cutting theme across all sectors. And then we're also looking at innovation policy being brought to the main, and so that the Innovation Council will have to be asking the President and the Vice President to take the lead. So this is the kind of area, and then the kind of funding that is going to come to sit at the national, like Innovation Fund, Challenge Fund, all those kind of funding arrangements are going to be like centralized so that everybody would have access. But for you to have access, you have to have triple or quadruple helix, which means we want academia and research institutes and private sector, government, and maybe also civil society to work in partnership. We'll call this knowledge transfer partnership. We need knowledge transfer partnership to take all the inventions and all our ideas to the market using those partners and accessing the fund. And that same message is so critical because we've got to move away from dependence on, we're not dependent on foreign aid, but we're going to move away to focus on exploiting our strength, working with translational research, working with foreign partners, local partners, and all of that to take ideas. And we have lots of those. Go to our research institute, you're going to see things that they have invented. IITA has got yam that multiplying yam seeds.
Prof.
So there's so many inventions. So
Professor,
we need to have a partnership that will take that to the market.
Ken, if interesting, we didn't even have time to talk about the structural weakness in our own economy. Beyond COVID-19 and how we can handle that. But thank you so much for the enlightening analysis, Professor Ken IFE there.